Good afternoon, and welcome to the Foundation for Teaching Economics webinar, The COVID Economy, What's Next? Today's talk will highlight new data and trends in the U.S. economy and the evolving policy responses. I'm Ted Tucker, Executive Director of the Foundation, and it's my pleasure to introduce our speaker today, Professor Scott Baier. Professor Baier is currently the chair of the Economics Department at Clemson University. In addition, he has served as a visiting scholar of the Federal Reserve Bank in Atlanta and was a senior economist on President George Bush's Council for Economic Advisors. Professor Baier's research interests focus on understanding the causes and consequences of globalization, the economic impact of free trade agreements, and economic growth. He is also a longtime instructor in our Economics for Leaders program, and I'm grateful for him giving today's presentation. A recording of this webinar, along with Professor Baier's slide deck, will be posted on the FTE's website 2 or 3 days from the conclusion of this presentation. After his talk, we'll have about 10 to 15 minutes for questions. Please use the Q&A feature when submitting your question. Also, following the webinar, we ask that you complete a short survey on today's presentation. So with that, I'd like to turn things over to Professor Baier.
Hi, good afternoon to everybody on the West Coast and good evening to people on the East Coast. I want to thank FTE again for giving me this platform to talk a little bit about how an economist sees what has happened with COVID-19 or coronavirus and how it's impacted the real economy. So if you've been to one of the 2 other lectures I've given for FTE, this is going to be in some ways similar, but I think I'm going to bring in some new insights and some ability to evaluate some of the policies that were implemented a little bit earlier. So I'm just going to go ahead and launch into the talk, and again, we'll take questions toward the end when I wrap things up. So again, we've probably all seen maps like this that give us daily updates of what's going on with respect to this health crisis that is the pandemic or COVID-19. So yesterday was kind of a milestone day in the U.S., a grim milestone in that we passed over 200,000 deaths in the U.S. And you can see now as we're approaching nearly 7 million cases confirmed in the U.S. This pandemic has created a little bit of I wouldn't say a dilemma for economists, but it was something new. Normally, when we're looking at economic data and the economy moves in relatively slow fashion, GDP doesn't slow down all at once and unemployment doesn't spike all at once. And so usually we could wait for our normal government data to trickle in at the end of every month or every quarter, and we can make some assessments and implement policies. But things happen so rapidly with the coronavirus really impacting the economy in March that economists had to look at other data sources, use the world of big data that weren't necessarily government generated, and kind of take again a 50,000-foot view of what was going on in the economy and taking daily stock of what's going on. So part of today's talk is just going to show what some of this new data that we were looking at. Most of it's available publicly, and if you want, I can write a short little paper, short note about how you would get some of this data if you wanted to present it in some of the class. As Ted said at the outset, all of the slides will be available. So again, the introduction. What is this? You know, it really is a natural disaster which had important twists. It's global. The duration of this shock is unpredictable, and the economic toll is enormous and potentially durable. We just don't know a lot of these things. If I was going to make one recommendation in some way away from economics, I think one of the things that we've learned is it seems to be a little bit too early in the game for countries or states to take victory laps in terms of we ended up doing better than you, because we see in certain areas now We see cases rising again in Europe and cases rising again in the Midwest, and the South had an experience with cases rising over the summer. So again, I think it's all a little bit too early to take victory laps. We should all take our precautions in terms of how to best limit the spread of the disease. It's a health crisis that has spilled over and created an economic crisis. And it's a perfect storm of economic difficulty. It had supply side implications. It disrupted value chains, both internationally and intranationally. It's impacted the demand side, and it's had financial implications, again, extending beyond just what we think of stocks and bonds. It's made financing for some firms very difficult. And all of these things have led to and involved government action or reaction to the nature of the shock. And I guess the easiest place the place to start in terms of economic data where we saw COVID-19 impact the economy was with respect to the stock markets. And here we're going to take a quick look at the Dow Jones and S&P 500. And I'm going to go through this relatively quickly. What I did was I went to the beginning of the year and I benchmarked both of these stock market indices to 100. So we can think of any deviation here as being percent change from where we were at the beginning of the year. And there are a couple notable dates that fall into place. Late February, there was a large drop in the Dow Jones Industrial Average over the last 2 years, and it came about because of fears of COVID-19 spilling outside of, say, China and now impacting the US and Western Europe. Another important date where I think most people remember, at least I remember clearly, where it came to the forefront that this pandemic was going to affect our daily lives it was the day after the NBA, MLB, and NCAA postponed all their games. I think at this point, the stock market again dropped dramatically. And I think everybody realized these events where we had large gatherings were no longer going to take place, at least for some time period. Again, I think both financially and economically, we realized that there was going to be quite an impact. The next date that I'm going to talk about as we go on is going to be this date of April 15th. We'll come back, and I'm not going to state exactly what happened then, but one of the things you could see was the economy seemed to be, the financial markets seemed to be recovering a little bit. But what I'm going to argue is around this date is when we started to see notable recoveries, not only on the financial side, but also on the economic side. Again, this time, this shock is different. This economic episode is different. Unlike the Great Depression, which was a financial crisis, which had also a flawed policy response that exacerbated both the length and the depth of recession. It resulted in high unemployment. This crisis did not have a finance side to it, and what I'll argue, the policy response wasn't nearly as flawed as it was for the Great Depression. Excuse me. The Great Recession, again, another instance of a financial crisis that spilled over into the real economy. Other crises that we remember, or other large recessions that we may recall, is the oil crisis of 75, really dated back to 73. This was a large supply shock due to a sharp rise in oil. It made manufacturing and industrial production more difficult, and that slowed down the overall economy. Prior to this pandemic, none of the above things were present. In fact, financial markets were operating relatively well. They weren't in trouble. Banks were as healthy as they've been in decades. Real GDP growth was strong, buoyed by strong consumer spending. Again, the economy was doing quite well for such a long expansion. Both GDP was growing at modest rates. Unemployment was very low. Inflation was low. And we also had low oil prices, which again was helping to support some of the consumer spending. So I gave a talk back in January of the year, given the state of the economy, and I argued that at that point there was no recession in sight. So again, this pandemic really came seemingly not out of nowhere, but hit the economy much harder than anyone anticipated. Again, COVID-19 is a health shock. As I mentioned, it had a supply side factors that disrupted supply chains, and it also impacted the demand side. And on the demand side, I'll talk more about how it limited market transactions in order to reduce the spread. Now, use this terminology from time to time that the economy experienced a sudden demand shock. And when I mean a sudden demand shock, individuals stopped buying certain types of goods, and they could have done it on their own, by their own choice, or it could have been mandated, but there was certainly a sudden drop in the demand for lots of goods and services that consumers buy. And this shock is also much different than the Spanish flu, another health shock that we like to draw analogies to. Main difference between this shock and the Spanish flu was the overall structure of the economy was much different. Back in 1918, we were a much bigger manufacturing base. Fast forward to 2020, about 80% of what we produce and consume is services. And what I'll argue that industry was the one that was most acutely impacted by COVID-19. So again, to make a few comparisons to other recessions, and again, to highlight how this time is different, here are the periods. This is employment. I take the peak of what employment was at the start of the recession, and then ask how long does it take for us to recover to get back to that level of employment again. So one of the things that we could see with the 2000 recession, or the Great Recession, it took almost 79 months for us to get back to the same level of employment that we had before. We could see, again, 81 recession was relatively deep, but it only took about 27 months to get back to where we were before. One thing I want to highlight here that I think most non-economists are a little bit unaware of, it is the drop in employment, usually during a recession, doesn't happen right away. It takes some time. And again, think of yourself as operating a firm. You're not going to let people go right away. What you may do is you may cut back on some hours. So employment kind of lags the drop in GDP. In fact, you see here that the employment in the 2000 recession didn't reach its trough or its nadir till about 27 months into the recession. If we go back to what happened in March and April of this year, it was a sudden drop in employment. With the first month, we lost roughly 1.3 million jobs. The next month, we lost 20 million jobs. So the drop in employment was much different than any other recession we had. And what I'm going to argue here is even a favorable or extremely optimistic view of our recovery wouldn't have employment recovering until 17 months out. So at least probably not till August of 2021. So that's the most favorable view I would think that we could come up with. It's likely to take much longer than that. So again, hoping that it's going to be a quick V-shaped recovery and we get back to where we were by the beginning or the middle of next year seems like a rather heroic assumption. Also, again, to get a little bit idea that things are different, you could look at industrial production. And again, when you look at 2020, I won't spend a lot of time on this side. Again, when you look at 2020, it was immediate drop of industrial production. And again, a pretty rapid increase. So we dropped almost about 17% in terms of industrial production from where we were at right back in February. And we bounced back up, and now we're just about 8% down. And again, this kind of little tick here is giving some indication that the recovery is going to now be a little bit slower. So the next few slides, or as I go through the talk, I'll highlight why I think the recovery is likely to be a little bit slower as we go forward. One thing that we could also see, and you probably are aware of, on the financial side, at least as view of the stock market, the stock market's almost completely recovered from where it was at the beginning of the year. If you look at the S&P 500, I don't know where it closed at today, but given where it was a day or two ago, the S&P 500 was actually up on the year. The Dow Jones was down down just about 6% on the year. How do I interpret that, or how should we interpret that? Well, one, couple things. Remember, one, the stock market is not the economy. I think point two of why it's recovered is the stock market is also forward-looking in the sense that it's thinking about what's going to happen in the economy down the road. So I think people view that the economy is going to get better as we move into 2021. Third thing I think is also important, kind of showing up here in the data, though I don't have evidence, but it sounds intuitively correct to me, is remember the Dow Jones is comprised, and the S&P 500 are basically large firms, and maybe the rise in the stock value of these firms is just a bet that these large firms are going to be able to survive the shock of COVID-19 and its impact on the economy better than small firms. So if we think that those are the firms that are going to survive, it's likely the case it's going to manifest itself in stock prices. So again, those are the three reasons why I think why the stock market has rebounded. One, it's not the economy. Two, it's forward-looking. And three, remember, these are relatively large firms, and it seems to be the case that large firms are in a better financial shape to survive the shock than smaller firms. Okay, again, reminding ourselves that this time it's different. COVID-19 is a health crisis that impacted a relatively healthy economy that was at a later stage of its expansion. And as I stated before, this is a demand stop that limited market transactions in different sectors. So how the rest of the talk is going to be, I'm going to look at its initial impact, talk about the policy response, look again at the economic data after the policy response, and then draw some inference about the effectiveness or the efficacy of that response. And then we're going to look forward and say what's coming down the road, or what do we expect both on the policy side and on the economic side. So one of the first things that we witnessed, and this is using Apple's mobility data, again, it highlights just how quickly things shut down. If you go back to that image of the stock market, remember around March 12th, March 13th, the stock market dropped dramatically. Well, we have basically exactly the same thing occurring here. Around this date, individuals stop moving around as much as possible. And one of the things I'll show a little bit later is a lot of this stop in the movement of people moving around was done by the individuals deciding and households deciding themselves not to go out as much. It wasn't as much the mandates or the shelter in place order. Certainly that also put additional limitations, but a lot of people stopped going out, stopped going to restaurants, stopped going to other places, largely because they were worried about the health repercussions from going out in large crowds. So again, a very visual way here to see in terms of how people were moving around by driving or walking or taking public transit. We saw a dramatic drop around March. And what I did was I cut off at this date of April 15th, and we'll come back to that date and why it's important. But again, you see this dramatic drop and leveling off of mobility. If we look at consumer spending, what we saw with consumer spending was, again, a relatively large drop in consumer spending right around that time, March 12th or March 13th. It dropped dramatically for about 2 weeks and then kind of leveled off and kind of stayed that way around up until April 15th. So again, not only did people stop going out and moving around, they stopped spending as much as well. We can also look at how spending dropped by income group, and we have 3 classifications here. And by the way, for some reason, it's not showing up in the corner of this slide where the data came from. This data came from Opportunity Insights. It's a group that put together actually credit card spending and a whole bunch of different economic and health-related variables with respect to COVID-19. So these slides come from that. But again, we have 3 different categories of spending by income group. What we see here is high income groups. Their spending dropped the most, probably not too surprising, right? They had a lot of discretionary spending that they could cut back on, so they were going to have the biggest drop. The low income groups here also had a dramatic drop in spending, not as much because most likely they were buying goods that are more necessities, more day-to-day goods, and as you would expect, middle income group kind of fell in between. So again, we saw this relatively dramatic drop in spending across all income categories. Then we can look at different groups, different types of things individuals were spending things on. And not too surprising is the one area in which we saw a lot of spending increase in, or the only category that we saw consumer spending increase, was this area here, this category here, which is groceries. So here you can imagine this is when people were running out and buying toilet paper, paper towels, and probably stocking up their freezers. So we saw a rather dramatic increase in spending at the grocery store. But every other aspect that consumers spend on, we saw a relatively large drop. So entertainment dropped nearly about 80%. Accommodations and food services, going out to restaurants, dropped about 70%. Healthcare, which we think, well, this is a health shock. You would almost expect healthcare services, the purchase of those to rise. They fell by 60%. And again, when we think back what was going on, most routine procedures and other doctor visits and visits to the dentist and eye doctor, all of those things stopped. So again, we also had a dramatic reduction in spending on healthcare, even though it was a health shock. And you could even see here, general merchandise fell about 40%. So again, a very large drop in spending across the board. And what I want to make sure we understand here, or I deliver this point, is a lot of these large drops occurred in the service industry. And exactly why? Because it's individuals more or less meeting face-to-face, either with another individual or in large groups, which had the highest probability or higher probabilities of the spread of the disease. That's where we're likely to see the biggest drop in spending. Of course, when we see a drop in spending, if you've been to any of our FTE events and we talk about labor markets, we always talk that labor is derived demand. So if we see a drop in spending in one area, we're also likely to see a relatively large drop or changes in labor in those industries as well. So if we look, so here, excuse me, I forgot what slide, caught off guard by my slides. So again, what I wanted to show here and depict here is this is the spending drop in all of these categories as a percent as of April 15th. So consumer spending was down about 30% as of April 15th. Grocery spending was up 12%, healthcare down 54%, entertainment, accommodations and food services down 63%. So you can see this large dramatic drop in spending. I apologize for misguessing my next slide. But as I mentioned, in these same areas, you would expect, since the demand for workers is a derived demand, if there is a large drop, say, in going out to restaurants, then there's going to be a large drop of employment at those restaurants. If there's going to be a large drop in leisure activities, there's going to be a large drop in employment in those areas. And so what we see here, and again, think of what is personal care. Again, think of this as going to get your hair cut, nails, anything that's done along that lines. And so that had the biggest drop, and you can imagine why. So again, just thinking intuitively, what activities or what consumer purchases would put me at the higher risk? That's where we saw the biggest drops in spending. That's where we saw the biggest changes in hours worked. So again, we saw dramatic drops in spending, dramatic drops in hours worked in, again, very service-related industries. And this is another thing that separates this crisis or this recession from other recessions. It really impacted most acutely the service sector of the economy. Now going to data that's normally calculated by governments to kind of accumulate what happened. If we look at the job losses in March and April, we can see that in the leisure and hospitality sectors there were more than 8 million jobs lost. In education and health services, sorry for the typo there, almost 3 million jobs lost, and in business services, again, over 2 million jobs losses. And not too surprising, retail trade, again, very service related, person-on-person contact. We saw a dramatic reduction in employment in those industries. And manufacturing, construction both had more than 1 million jobs lost as well. So again, what we can see here is job loss was spread out throughout the economy, but again, most acutely impacting the sectors where we have customers interacting with employees, or we have events in which there are services, again, a lot of one-on-one contact and interaction. If we look at the size of the firms that were impacted, this was a paper that was published back in, produced back in March. The industries or the size of the firms that were most acutely impacted were small to medium-sized firms. And again, when we think of small to medium-sized firms, one of the things that we're concerned about is they don't have the ability to access finance like larger firms do. So again, I think when the government was taking a big view of what was going on, they also realized that small to medium-sized firms were going to be the ones that were going to be heavily impacted. Again, we're also going to go back, and when I talk about the fiscal policy in a second here, remember that it was a relatively healthy economy up until the pandemic hit. A couple more slides on employment, because I think this is the one that registers with people the most. It's the one that we talk about the most. This pandemic was great at producing charts that completely distorted almost the whole history of a data series. So again, going back to weekly unemployment claims, the highest weekly unemployment claim that we ever had up until this pandemic. The highest that we ever had was during the Great Recession, which was about 650,000. Once this pandemic hit, the weekly unemployment claims spiked and remained elevated for quite a period. So here I'm going to focus in on what happened back in March and April. At the beginning of the year, up until the unemployment claims jumped up in March. On average, there were about 218,000 people a week who had lost their jobs and filed for unemployment. On 1 week in March, the unemployment claims spiked up to over 6 million people who lost their job over 1 week. And we can see thereafter, the weekly unemployment claims have died down, but they still are quite elevated compared to where they were or have been traditionally. The last data that came in had weekly unemployment claims still at around 800,000. Again, we're still around 1 million mark, much more than what we've ever experienced in the past. And of course, we know that those weekly unemployment claims are going to then somehow translate into the unemployment rate that's measured in the economy. So again, looking at how this pandemic has distorted our other charts and just look different than anything we've experienced in the past. Going into March, the unemployment rate was 3.6%. It jumped up in a month to 14.7%. Most people thought we were heading up to 20%. I think going into May, almost every economist believed that the unemployment rate was going to go up to 18, if not exceed 20%. And then surprisingly, the unemployment rate started to decrease, and it's now down to 8.4%. But again, still very high, still lots of people who are without jobs. So what was the government response? So I got us up to about April 15th. So I'm going to go quickly through the government response. The government response on the fiscal side was to respond to the impacted sector. So the health side also was to provide income support for lower income households and the most vulnerable. Provide support to maintain employer-employee matches. And so what I mean by this was, again, going back to what I've stated a couple times already, the economy was relatively healthy going into this shock, that we wouldn't have expected people to lose their jobs. So there were employers who were really happy with their employees, and there were employees who really liked their job. this shock was potentially going to disconnect those people, and you may lose good workers, or you may lost that job that you really loved. One of the things I think that the government tried to do, and I think did relatively well, was design a policy so that workers may be able to stay with their employer, so to maintain those good matches between employer and employee. And also, they did a little bit to provide for the sectors that were most exposed to the shock. Again, initially, we're going to think it was the airline industry, some industry on the health side, and other transportation and industries along that line. So again, looking at the fiscal timeline, things evolved relatively quickly. Back on March 6th, we had House Resolution 6074, and it was a relatively small bill, about $8 billion, $8 billion being small. And that was mostly targeted on the health side, on research and development, public health, and medical supplies. So again, the initial impact was largely hitting on the health side. On March 14th, they passed the Family First Act. Again, this was half economic, half health. What they wanted to do was they wanted to make sure that individuals who were sick, or individuals who had family members who were sick, would have financial support so that they could stay at home and take care of themselves or their family. And that this passage of the Family First Act allowed that. It also increased the amount of COVID-19 testing and did a little bit of expansion of unemployment benefit. The main economic fiscal policies were the CARES Act on 3/18 and the second phase of the CARE Act on April 24th. So again, what was the CARES Act? Let's go over it real quick. One thing the CARES Act did is it provided direct payments to households, $1,200 for every adult and $500 for every child, up to a certain amount of income level. Again, so you're trying to provide income and income support and income maintenance for lower income households, low to middle income households, I should say. It also created the Small Business Loans program, or better known as the Paycheck Protection Program, PPP. And this was, again, to provide loans for small to medium-sized firms in order to help them stay afloat, and also in order to help them to maintain their employment. So if you're not familiar with what the Paycheck Protection Program did, there would be significant reduction in how much you had to pay back if you took the loan out and if you maintained your payroll. So in most instances, you would receive the funds for the Paycheck Protection Program, and if you maintained your employment, didn't fire any workers, didn't lay anyone off, you didn't have to pay anything back. So not only was it an interest-free loan, it was a principal-free loan that you didn't have to pay back the principal. So this was designed for firms that had less than 500 employees, designed to cover at least 6 weeks of payroll. It eventually expanded a number of weeks. They also created the Economic Stabilization Fund, which was known as the Main Street Lending Program, and this was designed for medium-sized firms, largely for medium-sized firms. The take-up on this Main Street Lending Program wasn't nearly as great as they anticipated to be. We may talk a little bit about that. So again, it was for medium-sized firms, also provided funds for state and local municipalities. Again, state governments are the ones who have to pay unemployment benefits. The state governments have other obligations. So the Main Street Lending Program was providing support for state and local governments and being able to fund some of these programs that typically occur when there's a recession. And it also provided a little bit of support for those industries that were impacted, again, air carriers and some other industries that were important for maintaining national security. Then the last thing that it did, again, it's important, is it expanded the unemployment benefits, not only in terms of duration, but also in terms of the amount given. So what it did was give, on top of what you would already receive, it gave workers an additional $600 a week. And from what I understand, talking with people who designed this program and people at the White House and other people involved in the government, the idea of what they were trying to target here was that the total amount of unemployment benefits would be equal to the workers, the median wage of a worker in the US economy. One of the things that happened was that most of the people who lost their jobs were below the median income level. So with their unemployment benefits, about 60 to 70% of the workers with unemployment benefits were actually making more being unemployed than if they actually had the job. And that's one of the things that we've seen now as we talk about things coming down the road, why there's an argument about what the unemployment benefits should look like going forward. Again, I put this slide in here just for informational purposes. If you want these slides at the end, it highlights each of the passages of the act and how much was allocated to each of the program. I'm not going to spend a lot of time, but I think this slide has a lot of useful information. Again, what was in the program, how much, and what areas were targeted. The Federal Reserve timeline, again, it began around the exact same time in early March. Early in March, Fed does what Fed does. It lowered the federal funds rate or lowered the targeted federal funds rate. Middle of March, it said, okay, we're going to have to take a little bit wider policy. So it changed the discount window lending rate. It brought back quantitative easing. Again, they didn't call it that, but that's effectively what they did. Again, large purchases of bonds at different maturity levels. And it also provided forward guidance in the sense that it trying to send a signal that the Fed was going to step in when needed to keep interest rates and to provide liquidity when needed. By the middle of March, just 2 or 3 days later, things deteriorated enough that the Federal Reserve, again, recreated a lot of the Great Recession programs. And then beginning in March 23rd, what the Fed also began to institute were programs that were beyond what was even done with the Great Recession. You know, normally what we think of what the Fed does is just provide normal liquidity, inject currency into the financial system, and not target any specific firm or really any specific industry. One of the things that the Fed did this time was it was allowed to enter almost directly into buying commercial paper or buying bonds, so that the Fed was itself lending directly to firms rather than buying in the secondary market. So again, one of the things that the Fed did here, other than generally provide liquidity, it was able to buy bonds or buy commercial paper on first issue from firms, effectively lending directly to firms. And that's something that the Fed has never done before. And what you can see how that happened beginning in March, and if you remember, interest rates and bond prices and some sign of liquidity are inversely related. So what we had beginning in March, we had this run to safety. So firms and other investors were worried about what was going on in the economy. The demand for bonds increased. That pushes up the price of bonds. And then when the price of bonds goes up, the interest rate falls. So this is this flight to safety where an increase in the demand for bonds increases the price of bonds but lowers the interest rate. Then again, going back to that timing you could see before, what began happening around March 11th was this cash grab, that all of a sudden firms were not able to get cash like they once wanted, so they started opting out and selling their treasuries. So you had a big, large increase in the supply of treasuries that pushed prices of bonds down. Interest rates went up. The Fed perceived this, and rightly so, as there's a real liquidity problem out there. Small and medium-sized firms don't have access to cash. And so what the Fed did around this time, if you could go back that one slide, they implemented all these programs to provide as much liquidity overall to the market and to firms as much as possible. And so what we saw was liquidity working. The financial markets calmed down. Firms seemed to operate better. And again, that manifested itself some ways in the stock market as we saw a continuous rise then, not a continuous, but a persistent rise in the stock market industry. So again, what I think the Fed did here was a tremendous job in terms of addressing the issues, providing liquidity, creating new things when nothing existed. So let me spend a little bit, talk a little bit about the PPP program, or the Payment Protection Program. Again, remember, it was small and medium-sized firms that were relatively hard hit. So one of the things that when you look at the data about the loans that went out from PPP, that if you look at firms under 5 employees and firms up to 9 employees, they received roughly a little bit over 70, let's call it 80% of the total loans. So you would say, wow, they received a lot of the loans, but when you think of it as an overall percent, they only received about 20%. So again, they were targeting these small freedom firms. A lot of these firms got loans, but the amount that they received wasn't necessarily all that large. So let me, before I come back and evaluate PPP a little bit better, now let's go back and kind of not fast forward, but now extend that time horizon rather than looking at things that occurred beginning at the first of the year and cut it at March 15th. Let's run it out until about a week ago. So if I look at total spending, what you could see around April 15th, that was really the bottom, and then you saw a noticeable increase in total spending around April 15th. And why is that? Several reasons. One of the reasons is that's when the paychecks went out and were deposited in people's accounts. So again, this provided liquidity and income for individuals. They went out and spent more. This was around roughly the same time as that extra $600 in unemployment benefits kicked in. So again, what you would expect is people got a little bit more income, they would spend more. And notice you're going to see that here when you look at the different income categories. Again, there's that April 15th. And now notice, who would you expect to have the biggest bounce in spending when they receive the check? Well, it's probably those individuals who have the lowest income, or the individuals who are most liquidity constrained, and that's going to be lower income households. And you could see that quite dramatic response there of low income households right around the time that those checks were being deposited, right around the time that they were getting those additional unemployment benefits. So again, part of that economic recovery, or part of the economic recovery, clearly looks to be the case, which again, just looking at the data, in response to the checks going out and the increase in the unemployment benefits. So again, a relatively dramatic increase, both for low income, and you even see it for middle income. And it's not surprising we don't see much in the way here of high income. Why? Because again, high income, not everyone received those checks, and two, their responsiveness to getting a little extra money wasn't going to be that great. Another thing I think you could see here relatively clearly in the data is this period here, as the checks were going out, as the unemployment benefits were going out, you saw a rise in income, a rise in spending across all income categories. But then notice what happens. We get to about the middle of June. Middle of June, everything seemed to level off. And again, why is that? You know, my guess is that this is around the time when the cases, COVID cases in the South and the Southwest started to spike again. And again, that's when we saw people pull back. And again, the spread of the disease, again, seemed to slow down the economy a little bit. The other area I want to highlight is this last area here that began in August, and it's an interesting area, and I want to keep tracking this. Beginning in August was the end of the additional unemployment benefits, and most people feared that consumer spending would drop dramatically once people stopped getting those additional unemployment benefits, but there doesn't seem to be any drop here. In fact, spending by low-income households seems to be rising a little bit. Same with middle income households. So again, what lots of people were concerned with is when the unemployment benefit checks went away, that consumer spending would bottom out. We haven't quite seen that yet. So if we make a quick comparison of spending compared to where we were April 15th versus, I almost said December, September 13th. Again, grocery store spending is the only category which is up. It's not as up as it was, but you could see other areas like accommodations and food services that once was down 63%. Now it's only down about 24.5%. You look at entertainment, and again, entertainment isn't back. We don't have concerts. Not a lot of movie theaters are starting to open up. It was down about 72%, still down about 58%. Healthcare down 54%, now down about 9%. So you see certain areas, things are starting to bounce back, and so spending is not where we were at the start of the year, but it's moving in that direction, with the exception of a couple sectors. And again, it's the sectors that we would expect. Accommodations and food services, entertainment. Those are the areas which we fear the spread of the disease are likely to be highest, and even the healthcare sector, just again, because of the contact there. So again, what we're seeing here is kind of a return of some of the spending, but in the areas that are most impacted by the shock, spending remains down. If we look at hours worked, again, labor demand is derived demand. We saw that drop around the 15th of April when the checks went out. People started to spend their checks, get the additional unemployment benefits. And again, I shouldn't understate too, beginning around April 15th, it did appear as if the spread of the disease was declining. And so in addition to the checks, in addition to the unemployment benefits, people felt more comfortable going back out. Businesses started to make adjustments in terms of how they would address health issues for their employees and their customers. Customers were taking health precautions and venturing out, figuring out ways in which they could navigate through this health and economic shock. But again, so what we did see was this bounce back until about the middle of June, and somewhat of a leveling off here again that we've seen. So going back to a chart I already had so we could see it, we saw the jobs lost in these different industries. Now we looked at the job loss in March and April. I want to now add in the job losses and jobs gained. So the blue here is the jobs gained in those industries from May to August. Red is the job losses in March and April. And one thing you could see is there have been some tremendous job gains, but in most cases, say leisure and hospitality, we got about half of the jobs back. Same with education and health services. So in many of these industries, the jobs are coming back, but they're coming back at a rate of about 40 to 60%. So there's still a lot of areas, still a lot of job loss that needs to be recovered. But again, you can see the areas, some of the areas that were hit hardest are the ones that had the biggest job gains, but still a long way to go before we get back to where we were. Retail sales is probably the one where we had the biggest percent gain, and construction has done rather well as well. Again, just so you could sum things up, if you look at the job losses in March and April and the job gains, total job gains, we could add these up, and it roughly comes out to being 22 million jobs lost and a little bit over 10 million jobs gained over the last 4 or 5 months. So again, still a lot of unemployment, still a lot of job losses, a long way to go on the employment side for the economy to recover. Again, if you want to go back to mobility, kind of end with where we were on April 15th and where we are now. Kind of one thing that's surprising is the mobility has come back quite a bit. And in fact, if you compare where we were to the baseline in terms of walking, in terms of driving, we're doing more of that now than at the start of the at the start of the year. And again, in some ways, that's probably not too surprising. If individuals can't take public transit, you can't take the bus, you can't take the subway, then you got to walk or you got to drive. So Apple's mobility is picking up. People now using their own form of transportation rather than public transportation. But again, this is capturing some idea of some return to normalcy. I'll skip this one for the sake of time. Again, here's one of the things I wanted to highlight about the PPP and why it may not have gone like we had planned or how we had hoped. The industries that had, say, the biggest job loss were accommodation and food services. They got the not the smallest, but not very big share of the PPP loans. Whereas you look at manufacturing, construction, and professional services, they seem to get loans that were disproportional to the size of the job loss. So again, it doesn't appear in some ways it went out exactly to everyone. As well-intentioned as it was, it may not have been as targeted as what we would like. Another thing that we found was the distribution was unequal across different areas of the country. And again, this may have been a case that, look, in some areas that are more affluent, they have, it was easier for them to contact people to help them get the PP loans in areas that were less affluent. So there's some evidence that poor areas got less of the PP loans, even though they might have a greater job loss. So again, overall assessment of the initial round of policies, the fiscal costs were enormous. The economic response by the government was well-intentioned. Monetary policy, many thought the Fed had few arrows left in their quiver, but the response by the monetary authorities was swift, helped stabilize markets and provide financial support, generally for the economy, but also support for firms as well. Fiscal policy acted quickly. Payments went out to households relatively fast, supported, again, the policy was designed to support employment relationships, designed to support small and medium-sized firms that have the most difficult, maybe the most difficult accessing financial markets. And they provided funds for state and local governments. They probably need to provide additional funds, or probably not enough for state and local governments. Again, for the lack of time, I'll skip those. It's kind of a secondary to the nature. So what's next? Really, the one most reported package would be the next Republican, the package that was proposed by the Republicans. Again, what they propose is a continued expanded unemployment benefits, but not at $600 a week, at $300 a week. Provide $105 billion for education, with 2/3 of that going for K-12. Provide $45 billion for testing, tracing, contact tracing, and vaccine production. Extend the payment protection program. Again, make it a little bit more targeted. It provides some business liability. That's a concern for some individuals. Again, what is this? It made it so that it became difficult to sue your employer should you contract COVID-19. It also provided some additional funding for the post office that was originally a grant, and then, originally a loan, and they moved it to being a grant. What's not included in this package, and what the Democrats would like to see, is another round of the payments. Again, $1,200 potentially for each household, $500 additional for each child. Additional aid to the state and local governments, and additional support and legal potential legal assistance for housing and rental to make sure people don't lose where they're at. So kind of that's the stalemate. I would not expect a lot to happen before the election, but that's kind of what the next package looks like. Looking forward at the Fed, you know, back in the summer, Fed Chairman Powell said, we're not even thinking about raising interest rates. Again, that's a clear signal that interest rates with the federal funds rate are going to be near zero for the foreseeable future. Some interesting things that came out in some of the recent Fed meetings. The board projects that the GDP growth will be only negative this year and be positive and high in 2021. But the range of growth, what they speculate, is quite wide, larger than almost any other time. And presumably this is because of the uncertainty of the health implications. They believe that unemployment is expected to continue to decline, but the Fed expects the unemployment rate to be above the long run rate of 4.1% for some time period. In fact, going away from the Fed for a second, the Congressional Budget Office doesn't think we'll return to the level of employment or unemployment until, say, 2029. So it'll be a rather long recovery. Also, the Fed must believe that the economy is still structurally sound. Otherwise, they would have changed their long run forecast of what they think the unemployment rate of 4.1% is. Taking a look around, what people forecast for the remainder of the year, the IMF predicts, they're the most gloomy of all the forecasts for the US. They predict a negative 8% growth for the US the rest of the year. CBO is at about minus 6%. The Conference Board and the OECD are the most optimistic that GDP growth will only decline around 3.8%. Deloitte is at minus 6%, and Kiplinger is about minus 5%. Most of these forecasts, while they expect negative growth this year, have positive growth in 2021. Kind of the last two slides I'll go through is, again, this should say looking forward, federal budget implications. There's no doubt that all of this spending has impacted the deficit. The deficit was expected to be about 5% this year. It's skyrocketed up to 20%. Will be larger even if there's another fiscal stimulus that passes. What does this mean? Again, the overall debt held by the public was forecast to be 81% by year end. Now it's likely to be well over 100%. Again, so anybody who tracks the federal budget and the debt and the deficit, we know that the US economy was not in very good fiscal situation to begin with. This has done nothing to help. But again, when your house is on fire, there's things that you need to do. And so we'll worry, and hopefully we address the issues associated with the debt, once we get on the other side of this health shock. I'll go through this relatively quickly. Again, we've heard enough about flattening the curve. And one of the things that goes along with flattening the curve is when you have either self-imposed or government mandated lockdowns. A flattening of the curve, though it slows the disease, will likely spread of the disease will likely impact the economy as well. So there is going to be a relationship between either self-imposed or mandated restrictions and the growth rate of GDP. So it's just one thing that we have to accept, we have to get past. The one thing that we should worry about is, and again, it seems to be a concern if you look what's going on in Europe, if you look what's going on in some different place in the earth, is flattening the curve again and again can be problematic. And so I think what we've been learning over time, and this is that there are certain precautions that individuals can take on their own that help protect themselves and others, that help us reduce the spread of the disease. And the quicker we can reduce the spread of the disease, the faster the economy will recover. I think it's clear to most economists that the economy won't recover till we get, even as we make adjustments, we won't get back to a normal functioning economy, a normal looking economy, until we have this disease under better control in terms of spreading. So again, I thank you all for staying on. I've gone about an hour. I'll still stay on and answer any questions if we had them. Again, COVID-19 is a health crisis that has had large macroeconomic implications. GDP will likely contract between 4% and 8% this year. And again, it's my opinion that the initial policy response was fast and relatively well targeted. But now when we look at what policymakers are doing, it looks like business as usual, a lot of posturing and not enough to get things done, I think, for you and I, and to get the economy and address the health issues. So at this point, I'll stop and address any questions.
Great. Thank you, Scott. That was a great presentation. Lots of great data there. We do have questions, lots of them. So we'll start working our way through. We'll go maybe another 10 minutes if that's all right with you, Scott.
That's fine with me.
Okay, so the first question we have here, and if I mispronounce the name, I apologize, but Eric asks this question. He says, how would the Federal Reserve limit the inflation while also quantitative easing? Has this sort of scenario ever happened in the history of the United States?
Well, that's a great question. That's a concern I think that all economists have is, and I think any business person or consumer has, is when you inject that much currency into the economy, how do you not get inflation? Well, there's some evidence going back to the Great Recession when we did all the quantitative easing, that money never seemed to leak out into the economy and cause inflation. So what we're hoping for, and again, it is that the Fed is able to have what is often referred to as an exit strategy, that once the economy begins to recover, how do you take that money back out of the system in order to keep the inflation rate relatively low? But certainly it will be a challenge. But the Fed has last time showed it's up to the challenge. Let's hope they can do it again.
All right, we have a question here from David, who is asking this. How do you predict the outcome of the presidential election? How do you predict the outcome of the presidential election will influence market responses and government policy responses?
Well, certainly the outcome of the election will impact markets. But in terms of the economic side of what I would anticipate is if President Trump wins re-election, then I would expect something along the lines of that fiscal response that I showed. If he doesn't and Vice President Biden wins the election, I would expect there to be a broader package, a bigger package. What may have a bigger effect down the road is depending on who wins. And again, this is when we get on the other side of the crisis. I think where you'll see notable differences is if Vice President Biden wins, I think you'll see larger public goods spending in order to get the economy, employment back up, again, some more public works, maybe more green initiatives. You'll probably see less of that if President Trump wins election. So again, kind of recapping my answer. In the short term, going out 6 to 12 months, I would not anticipate bigger things, but longer term, in terms of how you would try to get the economy back, I think you would see a pretty big difference in the policies.
We have a question here from Samuel. Pretty straightforward question. Why is the stock market performing so well?
So I'll cover that again. I think there are several reasons. One is, again, the stock market is not the economy, but the stock market is forward-looking. As we saw, or I hinted at the end, most growth forecasts of the U.S. have GDP growth returning to be positive in 2021. So if we think the stock market is forward-looking, some of that's built in. The other thing I think that's important to understand, one other thing that's important is, again, the stock market is large firms that have better access to finance. I think so. Part of the rise in the stock market or the stock indices is it's a bet by the private sector or households or investors, I should say, that these larger firms are more likely to survive than the smaller firms. So that's going to manifest itself in the stock price. So again, I think those are the two main reasons why we've seen the stock market do so well. And again, third reason is, if you're an investor, where else are you going to put your money right now? Right? Bonds are so low. There's no other foreign market that looks relatively more attractive. So again, if you're an investor, that's where your money's likely to go as well.
All right, we have a question here from Tim. It's a two-part question, and it says, what is going to happen with the airlines in the next wave of layoffs and government aid? And then the other part of his question is the possible government shutdown in a few days a problem?
So the first one is, yeah, I'm not sure what the airline industry will look like when we get on the other side. I think as we're seeing here with Zoom, I think even though people will go through a little bit of Zoom fatigue, I think people are now finding that there are ways to conduct meeting and businesses without going place to place. But we will get back to, closer to where we were, because there's still things that need to be done face to face. So what I would expect to see is some additional support for the airlines from the government. There will probably be layoffs in the airline industry, and it'll look a little bit different. But that is the one area in which I would expect to see a change on the other side, or something structurally different. It was my understanding that there was an agreement, continuing resolution, that allowed the government to stay funded. So we will not have to worry about that again for another couple months. Sometimes I think we'd be better off if the government was shut down. Just kidding about that. No, I think there's a continuing resolution that allow the government to stay open.
I've got a question here from Virginia, and she's asking, could you speak more to the imbalance in PPP that gave more funding to lesser affected industries? Was it the application process flawed or some political posturing?
I don't think it was. I don't think it was political posturing. What I really think it was, I think there were a couple things. One, this was a program that was implemented in warp speed compared to how the government typically implements things. Usually it takes, if you go back to watching Schoolhouse Rock, I'm Just a Bill type videos, it takes forever for something to pass. And here is something that was cobbled together very quickly. I think it was well-intentioned, but it was done quickly without knowing all the ins and outs of what was likely to happen. And my guess is that some areas, some industries, not necessarily being better connected politically, but maybe better connected on the financial side, had easier access to those funds. You can imagine a construction firm having more employees in more market, being able to access the funds easier than a small restaurant. And that's what I think. I don't think it was anything intentional. It was just, again, the nature in which it was done and how quickly it was done, it led to some inequities in the distribution, or unequal. I shouldn't say inequities, because I'm not sure if they didn't get it right. The proportion may be right after all.
Great. Okay, Scott, it looks like we're running out of time, so maybe just one more question here. And we have a question here from Hashim, and his question is there a possibility of experiencing a W-shaped recession?
Well, that's always a possibility, right? If we don't address the health side and then we start to recover, the number of confirmed cases go up, the death rate ticks back up. Again, we go into either a government-imposed shutdown or a self-imposed shutdown. That will lead to a W-shaped recession. One thing I think that's almost off the table is a V-shaped recession, even though in many areas the rebound is quick. It's not going to be as dramatic or as quick as the fall.
Actually, Scott, before I let you go, I just spotted one other question I wanted to have asked here, and that's from from Joy. I'm sorry. Joy asks, what short and long-term effects do you see on state budgets?
Yeah, well, again, the states, it's going to be, there's going to probably be, again, short term, it's going to be very difficult. Long term, again, I think it's going to need federal support for some period of time. I worry about how education is going to be impacted, not only K through 12, but higher education. I worry about some of the universities that were, relatively small universities, the historically Black colleges, those type of entities didn't have solid funding to begin with, and I think they're going to be really impacted. But again, I think this state and local governments are going to need some support, and it's going to take a long time for them to recover as well.
All right, great. Well, thank you very much, Scott. I really appreciate you doing the presentation this afternoon or evening. Yeah. And thank you everyone else for participating. And I just wanted to remind you that to fill out, we have a short survey after this presentation. If you can just fill it out to give us feedback on both topics and how the presentation went. We're always looking to do things better. And then also, I'd like to ask then, or put in a plug in, on October 6th, we're going to have Dr. Louise Shiner from the Brookings Institute give a talk on the longstanding question of what is the debt capacity of the United States. I think that's would be a good topic given what Scott's presentation and his last couple slides about how the debt is drastically increased. So with that, just want to say stay safe and healthy wherever you are, and have a great evening or afternoon. Thank you.
Thank you, Ted. Thank you, everybody. And before you all go, let me again encourage you to, if you have an opportunity this summer, to take part in the FTE programs that are offered this summer, whether we do them live or virtually. Again, I think they're great programs for everyone. And I also think this is a great series that Ted has put on. I'm flattered and honored to be part of it. So again, thank you, Ted, and thank you, FTE.
All right, good night, everybody.